we always get, Danny, during the pandemic, we got the 4% rule is really the 2.2% rule. Then Dave Ramsey.
Oh, man, this is where...
boy, Dave Ramsey, I'm going to tell you, Dave Ramsey does a lot of great work about people that he must be pulling his hair out. Oh, we haven't here. When it comes to how people are spending.
A
little bit. Spending today.
So essentially, Dave Ramsey comes out and says there's an 8% withdrawal rate.
Yay, if I'm going to live 5 years.
But he blasted the people that says, the real rates that you should be taking out are much less. And he said, basically... These are super nerds who live in their mother's basement with a calculator.
How dare you?
You're listening to The Real Investment Show.
I'm going to tell you where recency bias, where... you think the conditions that exist today are going to exist forever or really will hurt you. And that is when it comes to withdrawal rates for your portfolio. When you're looking to take a fixed amount out of variable assets like stocks and bonds, that is not an autopilot decision. That is a decision that is based on cycles and how markets are working. Headwinds, tailwinds, what kind of cycle you're going to be retiring into. Even if you're in a tailwind, and it's best to have a tailwind early in retirement, is analyzing those withdrawals at least on an every 3 to 4 year basis. So we always get, Danny, during the pandemic, we got the 4% rule is really the 2.2% rule. Then Dave Ramsey.
Oh, man, this is where...
boy, Dave Ramsey, I'm going to tell you, Dave Ramsey does a lot of great work about people that he must be pulling his hair out. Oh, we haven't here. When it comes to how people are spending. A little bit. Spending today.
My favorite quote from this whole deal was...
What?
So essentially, Dave Ramsey comes out and says there's an 8% withdrawal rate.
Yay, if I'm going to live 5 years.
But he says... He blasted the people that says, the real rates that you should be taking out are much less. And he said, basically, these are super nerds who live in their mother's basement with a calculator. I mean, that was my favorite quote from this whole deal.
First of all, we don't have basements here. If I had a basement, I would be in the basement with the calculator. So he's right.
Nor do I live with my mother, but I
don't want to live with my mother right now.
A lot of money, right? Yeah.
I didn't want to live with my mother when I was younger. I don't want to live with her now, especially. She's in my closet. That's a long story. So listen, there's a happy medium between 4% and 8%. It's your rate. It's what you need. But it's also dependent upon how those variable assets are performing. So Morningstar comes out and says, we have got our brain trust to create this and say, definitely a 4% withdrawal rate has a 90% success rate over a 30-year time horizon. That's assuming a balanced portfolio of 50% stocks, 50% bonds. The highest starting safe withdrawal percentage since Morningstar began creating this research in 2021. That's a long time ago. 2021, since that long.
Well, Morningstar's been doing that much longer. David Blanchett was there.
But David Blanchett was really great looking at the academic side of reality of how people spend, right? Retirement spending spending more, then leveling it off in the active year spending first, then you level off for quite a period of time, and then as you age and healthcare costs increase, then that cost goes up. But she's saying the key tailwind for retirees is higher interest rates. How long? She's trying to tell us that higher fixed income rates are here to stay.
Well,
but especially with everybody locking up all their money in the short end of the curve.
That's the problem.
Yes.
If everybody's locking up in the short end of the curve, the problem will be is that it's not sustainable.
It's
now,
not.
if you go longer and you say, hey, I need 4.
And
you're not gonna see
buying
much
a bond,
growth.
and I'm buying a bond that's 4.
Correct, an individual bond.
Right.
Then yes, I think that's fine. And yes, that we are in a much better environment. You've got the wind at your back. That's great. But the problem will be is that you're going to face that reinvestment risk. And Janet Yellen, they issued Treasury debt. What did they do? They issued short. Why? Because she believes she's going to refinance this debt at a cheaper price in the future.
Although whatever Janet Yellen's doing, it's scaring me.
I know.
because
I
I'm
actually
agreeing
said that
with
to
it.
somebody yesterday. I was like, this makes perfect sense. But then I thought, oh my gosh.
Wait,
Janet Yellen.
Danny.
No, we need to do the opposite
Come
of what
into
she's
my
doing.
fray, Danny. Come into me. Come over here. Walk into the
Yeah.
Janet Yellen light, Danny.
But I get what Dave Ramsey's saying too, though, Rich, because look,
Plus, he thinks everything is going to earn 12%.
well,
so-
he's always said that. The problem is he doesn't understand the difference between arithmetic and geometric returns and how that actually works and how money works. If you look at a fun fact sheet, that's way different than what your money does. We've talked about this a lot with the rule of 72 and how,
Yep.
a
Yep.
fixed rate of return is required to get that to double your money. We're not dealing with that. We're not talking about the math of loss. We're not talking. That's the problem I think that Dave is missing. And I also think, in his defense, some of these guys with the calculators in their mother's basement are maybe a little disconnected from the average consumer and what they're actually doing. They're not real life planners. They're really good researchers. They're great with the numbers, but how money works and what people
I
do
don't
with
know.
it.
Yeah, maybe he meant it that way. I guess you could think of it that way. And again, I think Dave Ramsey, one thing about Dave Ramsey I'll give him, he's steady with the message, no matter how he gets berated by financial advisors.
He is fantastic for people who need to get out of debt. But at some point, and I think a lot of our clients have graduated from the Dave Ramsey kind of university, and now you can look at things that he may not like, and you can do things a little bit differently. From an investment perspective,
But
I
but you
have a
can't
real
s-
hard time.
I agree. But you cannot say the 4% withdrawal rate is back. You can say it's back for now because things change. Variable assets are variable. If you're telling me that I'm going to have a guaranteed income stream that's going to take care of most of the expenses that I need to keep a roof over my head, I'm okay with that. But I believe since 2019, and look at the S&P over the last 2 years, I'm usually off a year or two, S&P is not even where it was. What was the high on the S&P? 4,800? Roughly?
we're-
What are
we're
we at?
not there.
4,500? 4,400? and stuff?
45.
Okay. Not that everybody has all their money in stocks. And it's great for fixed income investors to be the kids in the candy store, to your point, Danny, have these rates. But how many investors do you talk to on their own are thinking about going out on the longer end of the curve and locking in the yields now that won't be here, as opposed to being so tantalized by this short end of the curve, which is not sustainable for a 4% 30 years. She's assuming for 30 years, you're going to get higher rates on fixed income. That's
you
not
can
what the
if you lock in a 20 or 30, right? I mean, that's
and good luck trying to convince just a day-to-day investor to lock up their money for a portion of it, right? They're not thinking of it that way. Fixed income is confusing to begin with.
I've had more people call recently and say, hey, I know you guys like the long end. I'd like to how do we put more money there? So I think it's, and that's not the average person, but people have begun.
Yeah.
I've had somebody who was very, very conservative, fixed income portfolio. He's just little by little been buying bonds and CDs. And, we've talked about adding to the long end of the curve for a while.
Yeah.
And trying to say, hey, let's think about this in a couple of different ways. And he's finally like, hey, I think we need to do it. Like yesterday.
Listen,
I'm like, yeah, 2 weeks ago would have been great.
Agree. I think the smarter investors, the more astute investors definitely are thinking along those lines.
But I think you still need, and here's the problem with this. It's like, number one, what if you're wrong? Number two, when equities start returning and the markets participate as a whole, how are you going to feel when you're stuck at 4.5%, 5%?
And Michael Kitches talks about this, and I'm a big fan of Michael. He's a great planner. This is what we worry about. Sequence of return risk. That's why I adjusted returns lower going forward in our financial planning software. A bear market after the day you retire is not that bad. It turns out there's no impact on retirement, but a sequence of returns of zero or sluggish returns over a period of time, a bad decade, as Michael talks about, that's what I'm worried about right now for retirees, anybody who's retired in 2019 on from now. That's what I've been concerned about.
Well, it's not necessarily that bad decade altogether. It doesn't mean that every year is negative. What it
doesn't
means
matter.
is
Right.
you have a very bad year or a couple subpar years put together. We may be going through that now. And you're taking distributions. And if you're taking 8%, it is going to be very difficult to keep, your principal or to get back to even at that.
And Michael's one of these guys who's in the basement with the calculator, and I'm grateful for that. But he talks about 65-year-old retiree planning for 30 years of retirement facing 3% annual inflation. $1 million, 60% stocks, 40% bonds would be rebalanced, assuming stock returns of 10%, bond returns of 5%, average portfolio return of 8%. Yeah, if I'm using these linear projections, he says, then take out whatever amount take out 6.6%, take 4%, you're going to be fine. But you have to keep in mind, and we're going to talk about this on the other side of the break, sequence of return risk is frustrating for an accumulator. It could be devastating for a retiree, especially as life expectancies increase. Although over the last couple of years, that's iffy. But longer term, we are seeing a higher quality of life for longer. When we get back, we're going to continue on this topic.
The Real Investment Show.
So, if you were going to have sequence of return risk, and I do think sequence of return risk is fairly high right now, guaranteed income becomes much more of an important part of your equation. If you're balancing scales during sequence of return risk, I want more guaranteed income while my variable assets sort of trail behind, especially for fixed expenses, not discretionary expenses. One of my old professor mentors would say that that's retirement nirvana is when you have all your guaranteed income is covering, whether it's Social Security, annuities, whatever it is, everything you need to survive every day. And you don't have to worry about it. David Blanchett came up with a great study that said that people who get guaranteed income, checks coming in every month, will spend more than those on variable assets. And that makes sense. Because the 4% that I'm taking today might be the 2% of tomorrow. So I got to bank some of that money to overcome the hurdles of the variability. When returns are bad in the first half of retirement, the safe withdrawal rate is not safe for all of retirement. In other words, when you first retire, you want this incredible tailwind of returns. That tailwind, that wind in your sails actually will carry for 30 years. If you have poor returns early in retirement, you have to manage you have no wind in your sails in the beginning. You could have wind in the sails in 10 years. It doesn't matter. The first
because you depleted your capital so much.
Correct. So you have to realize that the reality. So when we do plans, Danny, we talk about the reality of the numbers, right? The reality of the numbers are the numbers, valuations are the valuations, the guy in the basement with the calculator, math is math. If you're going to have great sequence of return risk, and we did these, we've changed these numbers to account for it in 2019. If this is going to be the case, we have to manage your distributions as such. You may not like it, You may not want to hear it, but as fiduciaries, we must tell you what our opinion is. Stocks aren't a panacea. They aren't going to get you out. They aren't going to make up for mistakes during headwinds. And if I'm in headwinds my first 5 years of retirement, then I've got a headwind for the next 25 years. No matter what tailwinds come later, because to Danny's point, I've depleted capital. That's why it's important that to understand that you will have a personal withdrawal rate that needs to be examined every few years, right, Danny? You have to make smart decisions with Social Security, pensions, and understand the value of an annuity bucket. Not everybody needs an annuity bucket, but some people do to carry them forward.
Well, I think the annuity, the fixed income, there's so many ways that you can recreate that paycheck. And you mentioned it earlier. I mean, it certainly feels good when you say, okay, I know what my needs are. Here's how I'm going to meet them. Social Security, pension if you have one, right? I mean, I know those are basically extinct, but there are still some out there. You look at any other sources of income that you may have. And then you start backing in and saying, okay, what else can I do to recreate the paycheck, to live the life I need, to keep that roof over your head, take care of your necessities.
Correct.
And then from there, you start to have a little bit more freedom where you can invest in the equities. You can have maybe an account that's a little bit more speculative. You can do things that give you more growth to keep up with inflation, to really make sure that you're seeing growth over the years. But like you mentioned, that sequence of return risk is so real those first 2 years. I mean, so how many studies show the first 2 years are so impactful?
Absolutely.
And then that first 10. Mm-hmm. And if you get in a bind, you may not get back to where you were. You may not see the growth that you expected. That can be problematic for some people.
And Michael talks about this. This is what we do here. We do a dynamic strategy. Yeah, you say you start off at a good sequence of returns, right? You start at a baseline safe rate. You can continue that. Then you get a good sequence. And guess what? You give yourself a raise. Or you put guardrails in. He calls them bumper lanes at bowling alleys. If the portfolio's growing and you hit the bumpers, you get more, right? If your portfolio drops relative to the spending and you hit an upper bumper, you adjust downward. So you can't just say blindly in a variable asset portfolio, I'm going to just take 4% in la-la land every year. It doesn't work that way. If I were a retiree, Danny, I would find that stressful. I'm taking 4%. Now I got to take 2%. Like, I would want a guaranteed income stream that buffers me, or Warren Buffets me against this, right? I would want this kind of buffer to take care of my expenses. Listen, when I first started in the business, we would tell clients, take your Social Security early and invest it, because I believed there was going to be this great tailwind to returns. In 2003, and I lost clients for doing this, I told clients, don't take your Social Security, wait. Start pulling money out of your IRA first. And I got looked at like I had 4 heads. Well, that's crazy talk. That's crazy talk. You have to adjust, right? Mm-hmm. Because variable assets are hills and valleys, and you have to adjust. And you could have, yeah, sure, every 100 years, markets always go up. You're not going to live 100 years. What if I get 10 years of sequence of returns? And
I love when somebody pulls out the history of the stock market. You're like, look at this graph. It's like, yeah, but look at the time. You may have 20, 30, 40 years that you're distributing assets.
Yeah, if you go into that, right? Like we always say, those are vampire charts.
Yeah.
Like Count Dracula gets those kinds of returns because he can hold the stock for 100 years.
You can't. And that index can take stocks in and out.
Right.
Which is a big difference.
So just be open-minded to crafting what your personal withdrawal rate happens to be. Part of your personal withdrawal rate is working longer or working another job. I just have a client that just took another job, a part-time job. They don't really need the part-time job, but it does affect the withdrawal rate of the portfolio, especially at times when things are rough. Because listen, if you have a diversified portfolio, you're not feeling good this year. You're feeling like crap. All right? You don't have your money in 7 stocks. There's no advisor with a sane mind that's going to put all your money in one sector in and in 7 companies. It's not going to happen. You think you're going to find that, but you're not. And if you do have that, when those 7 stocks do not perform, then that person's got to find the next 7. Good luck, right? You're going to have consumer staple stocks. You're going to have utilities. You're going to have healthcare. It's just part of the program. And that's the way it should be. You're going to have stocks that pay dividends. And frankly, dividend stocks were the worst performers. And I want companies with robust cash flows and lower debt and growing earnings. But we get all wrapped up in the narrative. That narrative about Ozempic, because Americans aren't going to snack, that kiboshed consumer staple stocks. You're telling me Americans aren't going to snack anymore and the market believes it? Come
First
on.
of all, I'm not taking any of that crap.
I have someone who's taking that right now, and they're nauseous all day.
Well, that's why they're
One
losing weight.
Yeah, but why do I want to? And one woman just died because it slows down your total digestive system. She lost 36 pounds, but now she's really lost a lot of weight because she's not here. These narratives, and Lance talks about this a lot, that grip markets, if you're going to invest in these narratives, then you're just this is the most tribal kind of investing I've ever seen. I understand psychology and emotions and all that, but this is crazy. To tell me that Americans are not going to snack anymore is cuckoo crazy. Right, Brent?
Absolutely.
And then you got to look at the companies. There are some companies that are still going to be, that provide healthy snacks. Again, you had Mondelez took it on the chin because you're telling me that no one's going to eat Oreos anymore. Come on. That is dumb. And then Mondelez comes out and their earnings are great and now they've recovered everything they lost. If you would have reacted to this dumb narrative that people that take a drug that's going to make them queasy and nauseous all day is how they're going to live their lives.
I love it how, though, they pinpoint a specific snack.
Oh, yeah, no. Well, actually, it did blanket a lot, but yeah, it's...
But
like,
what if it had the opposite effect? What if everybody said, you know what, I'm taking this, I'll eat whatever I want? Nobody's thought of that.
Yeah, like...
I mean, hey, well,
we don't need
I don't
that.
need
We
to eat
already
healthy. I can go eat this stuff because I'm not worried about...
But the problem is, I think the drug makes you nauseous.
But how many people are actually worried about health other than worried about
weight? Oh, yeah. Yeah, forget it.
Big difference.
I'm going back to my basement with my
your calculator? Yep.
And my phone for the Butterball Turkey hotline. If you want to call with the question, that's good. Is dark or white meat better for the planet?
Can you find a way to record this? Because I want to hear their reaction.
I will try to record.
No, I'm serious. I really want you to record it.
I can record these. But then you got to tell them you're recording. I don't know. It feels weird.
I don't know. You're in Texas, right? What's the law?
Oh, I don't know.
I don't know. Maybe we need to look that up.
I hope you all have a great Thanksgiving. We won't see you, or we won't be talking to you. And we're blank this morning on screen here for YouTube. But Lance is back on Monday. Have a great weekend, everybody.